Hello, everyone, and welcome to the January Market Update webinar. This one is called Markets 2025 Analysis and Insights. Before we get started, we're going to go over a few housekeeping items. One, there will be a Q&A session at the end of the presentation, as always. So please submit your questions using the question pane on the GoToWebinar menu, and we'll get to as many of those as we can. And of course, this is being recorded, so if you need to revisit something, if you miss something, have to step out, whatever it may be, there will be a recording of this uploaded to both our YouTube channel, and then we will also send it to you directly via email. So be on the lookout for that. I know we have a lot to cover, so let's get into it. So joining us, as always, is Jim Cahn, our chair of the investment committee. Jim, I'm going to hand it off to you.
Thank you, and thank you everyone for joining us. 2024 was really a phenomenal year for returns across risk assets, and we're going to talk a little bit about what we saw in 2024 and how that's going to lead us into 2025 and how to set appropriate expectations. With us today is Doug Huber, our Deputy Chief Investment Officer. He's going to talk a little bit about the macro environment. You're also going to hear him talk about prognostications around fixed income. Fixed income's been a really hot topic as we've seen yields really surge here at the beginning of the year. And also Aya Yoshioka is going to join us to talk a little bit about the equity markets and what we've seen in the past and what that may imply for the future. Really interesting stories around earnings coming around all this growth and talk about technology. And so really excited to hear what Aya has to say. As we look back on 2024, it was really a banner year. And coming into 2024, I don't think very many economists or talking heads would have said 2024 is going to see a 20% gain in major equity indexes. In fact, if you saw consensus estimates coming into 2024, most economists, most investors thought we were going to see a recession on the back of the interest rates continuing to be hiked by the Federal Reserve. And so I think it was a real that we actually saw back-to-back equity gains of 20% or more in 2023 and then again in 2024. As we come into 2025, that optimism is a little bit tempered. Why is it tempered? Well, the economy is actually doing so well. Unemployment remains low, growth remains high, and we're going to talk about the tremendous growth we've seen in the United States. I know that the mood in the country was a little coming into December, but if you actually look at what we've been accomplishing from an economic growth perspective, it's remarkable. But that growth has meant that inflation's been a little bit harder to get under control than what we might have expected coming into 2025. And so the Fed's kind of cooled the brakes on those interest rate cuts, and that sort of scared the market a little bit. Also, earlier this week, we got a little scare from a company called DeepSeek, a Chinese AI company that really sort of revolutionized the way that large language models, those are all those little chatbots you've been playing with, like ChatGPT and Claude AI, really sort of use data. And so I'm not sure that this is the technological innovation that we've been looking for in AI. It's really more of a series of optimizations, but it's called into question a lot of the heavy spending that's been done on tech infrastructure and whether that's going to be required. And we saw very large tech companies sell off because it's not necessarily a bad thing, but it is going to change the way the money gets spent around technology. The other thing that could happen this year is higher tariffs, right? So we hear the administration talking about using tariffs both as a weapon and also as a prize for countries that sort of toe the line around U.S. policy. And the question is, what impacts could tariff have on this tremendous growth that we see in the U.S. economy? Now, in some ways, tariffs could be positive because they could help U.S. manufacturers, and certain countries are just not playing fair when it comes to international trade. In other ways, tariffs could increase the cost of things that you buy at the store. Just think about when you go to a Target or a Walmart or you go to your grocery store, how many of those things come from overseas? And if there's a 20% tariff applied to those items that are coming into those stores, what happens, right? It's not like the companies themselves take 20% lower profits. They're going to pass it along to you. And so that could sort of complicate the growth picture and complicate the inflation picture. And so it's something that we have our eyes on. And so with that, I'm going to turn it over to Aya a little bit to talk about what we saw in equity markets and sort of what we could see going forward. Aya?
Thanks, Jim. Really appreciate it. So we thought, we would show the 2024 returns across all of our asset classes here. And you can see, and I'd like everybody to focus on these maroon bars because that's the full year there. The blue bars were the fourth quarter, and you could see the blue bars. We did see a little bit of a pullback, especially in December, across markets. And so the fourth quarter returns weren't as rosy. However, the full year returns were pretty good across many assets. So whether it was US equities and the S&P 500 that everybody's familiar with, up 25%. Small caps did well, up 11.5%. And then international stocks up 5.5% and 8%. That's pretty good. You're also seeing, fixed income, the high yield market was up 8.2%, and the U.S. ag was flat, up 1.3%. So solid returns across a lot of our global asset classes, and a 60-40 portfolio, which many decried being dead, was up 10.1%. So really strong returns, I think, across the board for asset class performance. And if you go to the next slide, one of the things, this is a slide in which it's the annual distribution of S&P 500 returns. And you can see, as Jim mentioned, we had back-to-back 20% plus returns. And the other thing that I love about this chart is that you can see that there's so many more years that are between that 10 to 20% and the 20 to 30%. So the probability that we have, double-digit returns is actually pretty high. And so, it's the median return is actually pretty good. Having, 15% type returns in any given year is a possibility. However, we do have to focus on the fact that that left tail, all of those sort of red bars and years are the ones that bring things down. And so, it's just another way to look at what type of returns could we expect. Typically, we don't always get a third year of 20% returns, and we'll have to see what 2025 brings, but we're unlikely to see another 20% plus return in 2025. And with that, I'll hand it to you, Doug.
Oh, sorry, I was just going to go back to that slide. I think this is a great slide because there's so many great stories embedded in this. I think you touched on not only just the rarity of two back-to-back 20% years, but also just the general kind of shift or skew to the positive here in S&P 500 returns. But if you look deeper, I think there's a couple other stories we could look at too. I mean, one, you tend to see if you have years that are towards the left side of this chart where it's been difficult, and there's periods where there's been 2 or 3 of those in a row, specifically the late 20s, early 30s, there's usually corresponding years to the heavy right side of this chart. And you can see that 33, 35, you can see that in 09 following 08. And so it does show that, while there are difficult periods, generally there is a recovery period shortly thereafter, and staying invested is important. I also think the interesting one here, and Jim, maybe you have some views on this too, a lot of what's been embedded in the 10 to 20 and 20 to 30% has occurred in the last 2 decades. And I think that's interesting as we will talk about kind of how our economy has changed over the last 25 years. And it's also been in a period of relatively generous monetary policy and pretty generous fiscal policy too. So it'll be interesting to continue to see where the data takes us, but I think that's an interesting observation.
Great point.
I agree with you, Doug. I think as you look forward, I think interest rates really do tell a lot of the story. And if we're in a high inflation, low growth environment, we're gonna probably sort of veer, unfortunately, towards the left side. If we're able to sort of conquer this inflation, get interest rates back down to a point that are accommodating to investment and spending, we're probably going to see a lot more positive outcomes as we've seen in the past. So I think tying interest rates to equity markets is something that not enough people think about. And I think now we're going to talk a little bit more about what's happened to the yield curve. So I think that's it's an important connection to make.
Yeah, perfect segue into just what we saw with the yield curve in 2024, and I think later we'll touch on kind of what we've been seeing more recently. But starting the year, the yield curve was materially inverted, and we had a market change in how it looked over the course of the year, particularly as Fed policy did start to become more accommodative. We started to get a better handle on potential inflation, and you started to see the Fed cut rates. And as you'd expect, the front end of the curve where they really control the rates came down materially. But interestingly enough, we saw the back end steepen a little bit. And I think that's been on the heels of just uncertainty around what we've talked about, right? Is inflation really under control? There's a lot of different viewpoints on that, and we'll touch on a few of the reasons why they're still kind of wrestling with, have we fixed it, or is there still more to go? The Fed has a dual mandate, right? And we saw some softness in the employment numbers. Now, not material. The economy is still pretty strong, and I think jobs are still relatively strong. But we did see some softness, which led to more uncertainty around, okay, what's the Fed going to do here? And this is a market, I think, where we are so dependent upon the Fed's decision, and they're very data-based. So generally, there's a good line of sight. But the market is really paying attention, and we flop between these environments of good news is good news to good news is bad news, and that happens periodically. And I think where we are today is that, if it looks like we have a screaming hot economy, the market actually is worried about that, right? They do want the Fed to get to a more accommodative stance, and I think that's why we continue to see the back end just is pretty stagnant. It's being stubborn back there until we get more clarity on what the future policies of the Fed will look like.
Yeah, and I think one of the things that surprised at least the equity markets was the fact that the 10-year rose almost 100 basis points after the Fed started cutting. So the Fed cut almost 100 basis points, and yet the 10-year went higher, which was a little bit of the shock, I think. And that was reflected in the pullback we saw in December, especially when the Fed indicated that they may not be cutting as much in 2025.
Absolutely.
Before we jump into these economic highlights, I just want to point something out. So Aya said something really interesting, which was we saw the 10-year Treasury really, the yield popped up to 5%, and the market fell, right? That's what Doug was talking about. But why did yields go up? Went up because people were optimistic. People thought that the economy was going to grow faster in the future. And so what are interest rates? Interest rates is basically the cost of money, right? So it's supply and demand. So when the demand for money goes up, interest rates go up. So if people think the future demand of money is going to go up because people want to buy stuff, they want to invest, they want to build things, right? Then interest rates are going to go up. Now, if you sit here and you think to yourself, how is the U.S. economy doing, right? What's the mood in the U.S. around the economy? You survey people, they're pretty pessimistic, right? They're not really excited about the economy. They're sort of think to themselves, right, we've seen better days. But the reality is that it's pretty good. So now let's go to the next slide, Tom. So since the fourth quarter of 2019, the U.S. economy, in nominal terms, has added almost $8 trillion. That's $8 trillion of economic activity. That's GDP growth. That's a huge number, 8 trillion. Okay, so the economy is actually growing really well. And so we think about China, right? And China has almost 4 times as many people as we do. They've only grown $4 trillion on a nominal basis, right? So we're not quite double the growth of China in nominal terms, but we have a quarter the number of people. That means that our people in the United States are actually getting richer than the people in China on a per capita basis and nearly double the rate. Okay, so that's tremendous. Now we go and we look at a place like the Eurozone, right? And if you look at the sort of sentiment of the Eurozone, it's way worse than the US, right? There's this conversation in Germany, has the German manufacturing engine sort of sputtered out? Do we need a new model for Europe, right? Same in France, right? Same in England. If you look at England, if you look at per capita England, ex-London, the average person in London, or the average person in the UK, ex-London, is less well off than the person in the poor state in the United States, which is Mississippi. Okay? So you don't often think about the Eurozone or the UK as places that are poor, but they are poor relative to the United States, given how fast the US has grown. And then we think of a place like Japan, right? So I remember going to Japan in 2008 and ordering eggs for breakfast. It was like $75 for a plate of eggs. Right? And they weren't even that, they were good, but they weren't great. They weren't $75 eggs, but they were good. Now you've seen tourism spike in Japan to rates that we've never seen because Japan is actually shrinking on a nominal basis. Things are getting cheaper on a real basis relative to US dollars. And we're seeing Americans who used to look at Japan as an unaffordable place to visit flock there in droves to take advantage of their great food, not eggs, but other things, and their beautiful things to see. And so I think when we sit here today and we sort of feel a little bit pessimistic about what the U.S. is relative to the rest of the world, we do have to pat ourselves on the back a little bit and just look at the tremendous growth we've had, at least in nominal terms, relative to the rest of the world. And the question is, can we keep this going? Because if we can, it's going to create a wonderful future for the United States and the people who live here. If we can't, we're probably in a little bit of trouble from a market's perspective. Doug, you want to talk a little bit about sort of where we're heading next?
Absolutely. Yeah, I think if we fast forward one slide here, I think this is a great slide as it relates to just how strong our growth has been here in the U.S. And I think this speaks to just one of the points I made earlier is just how our economy is evolving over time, and you can see services, as opposed to manufacturing, really continue to be in that expansion category. And I and I have had this conversation, numerous times. I think it's really interesting. I mean, if you distill this back to even the most basic thing, think about our lives day to day. I mean, how much of our spending goes to kind of service-oriented items, right? I mean, everything is a subscription now. Everything is, it is services-oriented, as opposed to being heavy industrials, right? And so I think this has really been the backbone of the expansion of the U.S. economy, and you see it in kind of the construct of our equity indices, right? Think of the largest companies in the world today. They are not the Dow Chemicals and the Exxon Mobils any longer. They are, the Apples and the Microsofts and the Googles and the Amazons and the Nvidias, right? These are all integral in how we think about kind of the services economy. And so, I think this is a chart that, we pay a lot of attention to. It's obviously had a very strong run, and you can see how strong it was kind of in the COVID era, right? Nobody was kind of out and about. And so, a lot of reliance on this. And while it's come back into kind of more of a, closer to its baseline, it's still in a growth, position. And so I think this is something as we think about the economy, this is really kind of the engine, these services that has been driving the impressive growth here in the U.S.
I would also add, Doug, that, we highlighted the prices paid index here because the most recent survey did see a pretty, big pop in the prices paid. And I think that's what, got markets a little bit more concerned that maybe inflation is going to come and be a problem again in 2025. But perhaps this was more, a lot of the people who provide these services, raising prices ahead of potential tariffs and other fiscal policies that might impact them in 2025. So a lot is yet to be seen, but that did catch our eye in the most recent ISM survey.
Interesting.
On the inflation front, this is, again, tied to what I was just talking about in the prices paid index. And the concern, I think, coming into 2025 is that, again, growth is really strong, as Jim just mentioned, especially here in the US. And so how are we going to get inflation down? Is it too sticky here? And is that why the Fed is on pause? And one of the things that we like to really look at, and this chart really goes and looks at when these numbers came into the annual core PCE each month. And what I like about this is that you see is that some of the gray bars there, the numbers that came in 10 to 12 months ago, those are going to actually fall off of the input as we go forward. And so, one of the things that really contributes to inflation is housing and shelter. And you see that, it's about a 45% weight in the core CPI number, and then it's about a 20% weight in the PCE number that the Fed really looks at. And so as shelter has been slow to come down, these inflation numbers have been slow to come down. But we do think, and we're seeing it across, other areas and data from Zillow and things like that, rents are actually coming down. At least they're not going up as much as they used to. And so we should start to see the overall numbers come down a little bit, or at least, get to this 2.5 to 2.7% range, and not be as accelerating back to the 3 or 3.5% range in 2025. But you've got the potential of tariffs and headlines that might move this later on in the year, because it'll take some time for these actual tariffs to work themselves into the inflation numbers.
Yeah, I think, we've talked a lot about kind of what is the market's perception of fiscal policy and monetary policy. And I think what's really interesting is the volatility of expectations is very high. I think last year when we entered 2024, I think we were entering with the market pricing in 6 or 7 rate cuts. And the expectations kind of petered down a little bit for 2024, and now entering 2025, we were going into it expecting virtually no rate cuts in the early meetings, and you can see roughly one rate cut now priced in for the remainder of this year. And that is a sharp departure from where we were probably 4 or 5 months ago. And I think part of that is data based, in that the expectation that we are still a little unsure of where our inflation is and how sticky it's going to be. There is still some uncertainty around how the jobs numbers can continue to kind of how accurate they are, and B, how they can continue from here. And then I think that the third piece of this is with a new administration coming in, the uncertainty around how fiscal policy will interact with monetary policy, and some of the pro-growth initiatives that the Trump administration has. How will they impact the future visibility we have into inflation? And so this is just really showing the kind of volatility and the uncertainty of trying to predict Fed rate cuts. And I think it goes to say that we are not pretending to have a crystal ball here. We try to position for the long term, but we certainly pay attention to all the data points that the Fed's looking at, and what's the market trying to tell us. And right now it's a little bit more hawkish, that we don't believe there's going to be numerous rate cuts, which would tend to kind of go back to Jim's point that maybe the economy is in a very good place, that growth is relatively strong, and that the market's saying, listen, that's going to maintain here for the next 12 to 18 months.
I think, Doug, the key word there is volatile expectations. And so each one of those dots is a prediction, and it's not a prediction by some talking head on TV. It's not a prediction by someone on our investment team. It's a prediction by someone who actually votes on Fed policy, right? So these are the people that are setting the policy, and they keep changing their own predictions. So they set the policy, which is sort of unusual, because you would think that people who actually set the policy would be able to predict the policy quite well, but actually they're not that good at it. And so if you're out there thinking to yourself, I'm going to be able to time the market, I'm going to be able to time these interest rate cuts, I'm going to time the equity market pops on these interest rate cuts, well, the people making the decisions can't, and so we probably can't either. And so I think it's just interesting to just see how much uncertainty and how surprised even the people setting policy were by the recent strength in economic activity. And I think to Doug's point, a lot of the new administration's policies are very pro-growth, reducing regulation, funding key parts of the economy that are generating growth, like chips and AI. And so that will have further implications, but it's very difficult to understand what they are. So trying to draw straight lines from headlines to markets is very difficult, if not impossible. So just be careful. It's very tempting to do so, but it's a very difficult thing to achieve.
And this this slide goes right to some of the prior points of how does fiscal policy interact with monetary policy. And one thing that we can't deny is our balance sheet continues to grow, despite efforts to maybe stop that. And obviously, if fiscal policy becomes more accommodative, it's going to be even harder for monetary policy to have an impact on that. And this is just a chart that kind of shows the proposed policies and what the effect of those might be on our deficit. Now, I think it's important to understand that we don't know how many of these are going to be to actually come to fruition. We don't know the extent or the magnitude to which they will. So it's hard to predict on this. But if you took what the administration was saying kind of post-election and put that in and took that for fact, what you can see is despite the pickups from tariffs in both universal language and to China specifically, the repealing the clean energy subsidies, that is nowhere near enough to offset the potential for individual tax cuts, repealing the SALT cap, extending other various tax cuts and credits. And so, this would continue to drive a growing balance sheet of the U.S. government. And it is a big point of contention in the markets of kind of how much debt can we take on and what is the cost of that debt. And so the interplay between fiscal policy and monetary policy will be very interesting from here. And it's something we're keeping an eye on, but it's definitely, we need to understand the full impacts of these. What is the magnitude of the policies being put in place, if they even come to fruition at all?
I think to put this in context, right, the amount of debt you have only matters relative to the amount of income you have. So if you make $100,000 a year and you have $100,000 in debt, if you make $1 million a year and you have $100,000 in debt, probably doesn't matter as much. So if you look at U.S. deficits to GDP, GDP is kind of like our income. Debt is kind of like the debt, it's about 100%. So we're more like the family with $100,000 of debt and $100,000 of income. And so the question really is, will these investments, and really, these are investments when you have, additional spending. Will these investments actually spur more growth? If we lower taxes, if we repeal the SALT caps, if we extend business credits, right? If we do all these things, will that actually spur growth? And if it spurs growth, then maybe we can afford the additional $4 trillion of debt that these policies are projecting. If we can't, then at some point, right, our credit card company, which is basically all of us that holds corporate bond, hold treasuries, and the global community that holds treasuries, can ask the question, like, how are they going to pay these back? Right. And because we are the reserve currency, the dollar's the reserve currency, and because historically we've had a very good credit rating on a global basis, people aren't really asking that question in a big way. But we did see in the UK, right, going back to the United Kingdom, when they sort of proposed a budget that was going to expand their deficit, the bond market kind of freaked out. And the yields went way up on government bonds in the UK, and it actually toppled the government, and it brought in sort of a period of turmoil in UK politics. And they had to sort of come back with additional tax and an additional way to control the deficit. And so even though we're probably not at that tipping point yet in the United States, we do have to sort of think about how do we avoid becoming like the UK, and how do we make sure that when we make investments, when we spend money as a country, we get something back so that our debt to GDP ratio starts to actually shrink. Right? Because we're pretty much at the highest we've been since World War II. World War II was really expensive. And the question is, how do we sort of work our way out of this debt position in the same way we worked our way out of the debt position in the 40s, or in the late 40s and early 50s, last time we sort of saw this level of debt. So lots to think about.
Yeah, no, great points, Jim. And, I think when we bring it back to the equity markets, one of the things that we know is that earnings drive valuations. And so we believe that, again, earnings are what drives equity markets over the long term. And what we're seeing in 2024 is that, about 9% growth in terms of earnings growth. And then 2025 is expected to have earnings growth of about 15%. And what's interesting is that when you dissect that across all of the sectors, it's going to be the first year in which all 12, if it ends up being the way it's estimated to be, all 12 sectors will actually show positive earnings growth. That hasn't happened in a few years now. And so seeing that and at that broadening out that we all talk about is actually a reflection of the strong economy that Jim was talking about, and a reflection of the strength of some of the companies within the S&P 500. And so we'll continue to see, this growth, this underlying growth. The problem, I think, when we look at equity markets for 2025 is the valuation side, the multiple. How much do you pay for this earnings growth? And a lot of this was sort of reflected and brought forward in 2023 and 2024. We're already at about 21 times in terms of the valuation for the S&P 500. How much higher does it go? And how much you pay, your starting point really does matter, especially over the long term. And so we want to make sure that, again, perhaps we see a little bit of a pause, perhaps we see some consolidation in the equity markets. And we think that would be really healthy in equity markets because it allows for that earnings, that denominator, to grow while the numerator stays relatively flat. And that allows the overall valuation of the market to come down and be a little bit cheaper than what it was or what it is right now. So we think that volatility is going to be something that is part of 2025, but we think that it's going to also provide opportunities across the board in 2025.
Aya, do you think, we've looked at this a little bit, but the largest positions, as you pointed out, had accounted for a great deal of that growth over the last couple of years, and obviously with the broadening that you mentioned here, if you looked at the index X, those top 7 or 10 names, is it as expensive as it would be at a headline level, or is it more normalized with the other 490 names in that index?
It's a great point, Doug. I think the earnings growth differential between those top 7 names and the bottom 493 was almost 30% in 2024. And as you see in 2025, that differential starts to narrow because, trees don't grow to the sky, and so you're not going to continue to see 30%, differentials. You'll see the earnings growth of some of those larger companies come down. They're still growing, but not to the extent and at the growth rates that we saw in prior years. On the flip side, some of those, 490 or 493 names are actually going to continue to grow, especially as the economy grows. They're a little bit more sensitive to economic growth. And again, in a robust economic growth backdrop, those companies can do really well.
So, I mean, the headline on equity markets is pretty clear. They're really expensive, right? So under all the, the indexes, yes, you're going to find some pockets where stocks still look fairly attractive on a valuation perspective. But the reality is that the equity markets taken as a whole, right? If you look at the big indexes, they still look expensive. And the question is going to be, and what really drives the outlook, especially for equities, is can we sustain that valuation? And the first part is, can we sustain the earnings growth? And the earnings growth that's baked in for 25 is really high. And historically, what we've seen is when we have high earnings expectations, right, we tend to see a little more disappointment. When we have low earnings expectations, we tend to see a little bit of outperformance. And so while I'm excited about where the economy is, I'm excited about all the new technologies that are rolling out, I'm excited about the productivity gains these companies are making, right? They're doing more with less. I'm a little nervous that we're going to see some earnings disappointment, especially as we get into the back half of the year, and that's always rough on markets. The second thing we're looking at is inflation, right? There are a lot of reasons to believe that inflation's probably not going to spike again, right? As we were looking at some of these charts, some of the big price increases are rolling off. But there are other reasons to believe that inflation's probably not going below that going to that 2% or below that 2% target that the Federal Reserve set. And so if inflation sort of stays middling, we're not going to get the interest rate cuts that are going to make equities look a little more attractive to fixed income. And that could also hurt equity markets on a go-forward path. As we shift and we kind of look at fixed income, right, if we don't have those cuts in fixed income, or if we don't have those cuts in interest rates, it's sort of a question of, well, where are we going to get the return? Where are we going to get the price appreciation on fixed income assets, especially high quality fixed income assets? And the answer is we're probably not. What we're probably going to get out of fixed income is we're going to get higher yields, which we haven't seen in kind of close to a decade. And those higher yields are really attractive at this point for two reasons. One is they're just paying you more. And two is if we do see a hiccup in the economy, if the forecast is wrong, if we see some surprises that knock us off course, those bond prices are likely to appreciate. And so it's worthwhile having some bonds in your portfolio. As we look at current opportunities, we still like U.S. equities. If we look at companies in the developing and developed markets like Europe and Japan, a lot of those companies aren't innovating. They don't have the same technology, the same productivity gains. So we're talking about the leaders are in the service sector in the U.S. If you look at the leaders in Europe, they're still old industrial companies. They're luxury good providers, right? They make things still. They're not service companies. And so they haven't sort of evolved the economy to a higher margin place where the U.S. economy has evolved. And that's really helpful for U.S. equities, even despite the fact that valuations in the U.S. look so much higher than where they do in developed markets. Now, that doesn't mean you shouldn't own any developed markets, because if the U.S. continues to run, right, the U.S. will lift all boats. And so the cheaper valuations international could eventually catch up a little bit. And so it's worth having some of that in your portfolio. As we look at fixed income, again, as I mentioned, I don't think there are big returns to be made in fixed income, but it's an interesting way to sort of protect against some of the volatility that we can have in equity markets if we're wrong. And remember, we don't know, right? Even the Fed policymakers don't know. And so it's important to have that protection in your portfolio. And the bottom line, and I think where we've left this podcast, every single podcast going back about 7 years now, is it's important to stay diversified. Okay, and the reason why it's important to stay diversified is at the beginning of 2024, if you had listened to all the experts, they would have told you to cut your equity exposure. And if you would have done that, you would have missed materially on one of the best equity markets we've seen in a decade. Right? Today, you're hearing stay in equities, get out of fixed income. Interest rates are going to stay high, inflation's going to go up, right? But people are likely to be wrong. And that's why it's important to be diversified, because you never know which asset class is really going to drive returns for that year or is going to protect your portfolio. And so with that, Tom, I think we have time for 2 questions. So do we have two writing questions?
Yeah, we got a few questions here. First one, I know we touched on this a little bit, but what are the chances 2025 can be another year with 10% or more returns?
Aya, do you want to take that?
Sure, I can take that. I mean, as we talked about in that chart where we saw the annual distributions, the probability of having a positive year, a double-digit year, is high. Unfortunate thing is that it tends not to happen, 3 times in a row. And then, we do have earnings growth of about 15%. And as Jim mentioned, expectations are kind of high. And typically, as we go through the year, that earnings growth is probably going to be closer to that 10% range versus 15%. And if you don't get a change in the valuation of equity markets, you might see a 10% type year. But if you do see a change in the valuation, you'll also see potential higher or lower in that 10% range. So we do think high single digits is possible. But again, if people start to worry a lot more about inflation, if the Fed doesn't cut and perhaps even talks about a hike start to enter the conversation, you could start to see that valuation multiple, what we pay for equity markets, come down, and that could have a bigger impact in terms of your overall return in 2025.
I just said one thing that's there are only 2 things that change equity prices. Okay, so there's a lot of swirl and there's a lot of noise, but there are 2 things that change equity prices. The first is interest rates. Higher interest rates, lower equity prices. Lower interest rates, higher equity prices. That's because the discounted cash flows, the cash of those equities, the dividends and the earnings that those equities are going to give to you, they're worth more when interest rates are low, and they're worth less when interest rates are high. The second thing is news about earnings. So when we have news that suggests that future earnings are going to be higher, stocks go up. When we have news that future earnings are going to be lower, stocks go down. It's challenging to see an environment where interest rates are going down a lot, right? So we've got one little area, right? We've got one of our 2 sort of factors that drive equity prices. We don't know exactly, but it's tough. On the earnings side, it's also kind of tough to see how the earnings expectations could get any better. And so one of the reasons why I think you don't see 3 years in a row of 20% plus returns in equity markets is that, people do sometimes think that trees grow to the sky. And so oftentimes, as you sort of come out of these periods of exceptional returns, people anticipate exceptional returns. And so it doesn't mean to get out of equities, but it does mean temper your expectations for returns in 2025. It's much more likely to be a normal year of sort of 6 to 10% type returns than an exceptional year of 10% plus returns. And again, we can't make predictions. So we'll see. But if you just look at the facts as they are on the ground today, that's kind of where I would my prediction. Tom, one more question.
Yeah. What sectors do you think could benefit from this new administration?
Doug, you want to take that?
Sure. I think obviously we touched on this new administration's pro-growth policies, a lot of them targeted to the AI and kind of tech sector, and you've seen them kind of continue to run post-election. I think people are optimistic about deregulation and what that could mean for these higher growth areas. It was interesting to see at the inauguration some of the people standing behind President Trump. We have the CEOs of the largest tech companies in the world standing there, and so you can clearly tell that there is and will be a continued tie to kind of the technological growth here in the U.S. On the flip side of that coin, the administration is pro-energy, right? They're pro-energy independence for the first time, and there's a lot of policies being enacted that you could think are beneficial towards traditional energy businesses, oil and nat gas, especially here in the United States. And so, it's hard to predict what sectors would do better, but those are definitely 2 that at least publicly have received praise and certainly have received a lot of attention as it relates to this administration's policies. I mean, Aya, do you have any other thoughts beyond those 2?
I was just going to add to just, Jim mentioned deregulation and just sort of this, the animal spirits that sort of come up, and that really portends well for mergers and acquisitions. And what that could mean is it's a positive for a lot of financial companies that provide, the, matchmaking for the M&A and bring deals to the forefront. So you've seen some of that in financials, in investment banking, and then perhaps we will see some better IPO activity which again, positive for financials overall and a lot of the money center banks.
Yeah, that's a great point. I mean, we've already seen. Oh, sorry. Go ahead, Jim.
Oh no, go ahead, Doug. I think you're going to make the same point I was. Go ahead.
I was just going to say, in general, right, that deregulation in the financial markets, goes beyond, to your point, you touched on the IPO activity, right? I mean, corporate deals getting done is a big piece of how our economy continues to grow. That filters through to the private markets, and that is a big chunk of our economy, and we're seeing deals being unlocked in more economic and capital markets activity in the private markets, which just bleeds through to the public markets. And so, in general, it is, easing up financial restrictions tends to be kind of an overall benefit to the economy.
Great point, Doug. One point I'll make just before we wrap up that I'd like to discuss at our next investment management offsite is the administration is very pro-energy, pro-drilling, pro-energy independence, and I think that could be a really interesting, that could have two outcomes, right? So energy is driven by supply and demand. So if you increase the amount of energy that's actually being produced, oil and gas that's being sort of extracted in the United States, that should actually drive prices down. And some of the things I'm hearing from my friends that are relatively close to the administration is that one of the ways that they want to bring inflation down is by bringing down the price of energy. And so it could be a double-edged sword for the energy sector because you could be in a situation where there's a lot of encouragement for investment, but the actual price of the substances that they're selling in the marketplace actually falls further. And so I'm curious to see how that plays out in the energy sector for equity prices. All right, that's just some idle speculation to drive some additional conversation later on for the team. But I appreciate everyone for joining, and I look forward to having you join us next month when we bring you this podcast. Thank you again for listening. If you have questions, please send them into your advisor, and we'll make sure that one of our roundtable specialists answers them in a prompt way. Thank you again.